Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss step 3 of the Fundamental Retirement Plan, tax planning. Specifically, I'm going to chat about the difference between tax planning and tax advice, common strategies we develop for retirees, tax planning for incorporated professionals and business owners, the key benefits of tax planning other than reducing your tax bill, our 2 most impactful client value adds, and lastly, as always, a few action items for you to consider. You'll hear me talk a lot about visibility when it comes to retirement planning. To you, this means being able to see how the impact of the decisions you make today will impact your future financial security, your retirement account balances, and the amount of tax you will pay now versus the taxes you'll have to pay later. You wouldn't hop in your vehicle at night in a blizzard, not put on a seatbelt, not turn on your heat, no headlights, and just drive down the highway. No one would do that. We need visibility so we can make good decisions and we can react and adapt when needed. When we are planning for your retirement and drawing from your investment accounts, you simply need to understand how the decisions you're making today are impacting your ability to stay retired in the future. All this to make it to step number 3 of our process, tax planning. This step is completed at the beginning of our relationship and as we go through the FRP process. But more importantly, it's something we continue to review and optimize throughout the relationship. So remember, step 1 is investment allocation. We need an allocation you're comfortable with that is in line with your risk tolerance, time horizon, and expectations. If the investment allocation doesn't align, maybe you have too much risk in your current portfolio. When markets go down, you may be urged to get out of the markets and the plan blows up, leaving everything else pointless. This is why investment allocation is step 1, as we need you comfortable with your portfolio, but also in the position to achieve expected returns to help you draw an income and reach your retirement goals. This leads us then to step number 2, the income plan, where we get a solid understanding for how you spend, your cash flow needs, and other spending goals like travel or gifting that you may have in mind. Once we have that income plan, we can really drill down on the tax planning discussion. Now, from a client experience standpoint, we are working on all 3 of these steps in concert with each other between our first few meetings and after we've gathered all the required documents from you. The 3rd step, tax planning, is incredibly crucial to your long-term retirement success, and one of the core reasons we address your tax planning at the beginning, but also on an ongoing basis. What I'm going to cover today are a number of tax strategies we may consider applying to your situation. While making this episode, I reviewed our tax planning process, and the reality is that there are 50 or so different tax planning strategies that may be applicable to your situation. Through our process, we layer these potential tax planning strategies into the overall financial plan and present to you the most relevant strategies for your personal scenario. Personal finance is personal, and this includes tax planning. Now, before I jump into a few of these strategies we consider, you should understand that even though there is a lot of math behind tax planning, it is very much an art. The easiest way to explain this is that if we take money out of certain accounts and decide to pay more tax today to pay less taxes over the course of time, how does that make you feel? You'll have to write a check to CRA, which means less money in your account earning an investment income. So even though the math may tell us one thing, we need to make sure that the decisions we're making today also make sense in the context of your overall plan. Another quick distinction I should make is the difference between tax planning and tax advice. Tax advice should go to your CPA, Chartered Professional Accountant. They're looking at everything that has happened over the past year and hopefully creating some type of strategy to help you pay less tax in that year's basis. What we do from a tax planning perspective as your certified financial planners, well, we have far more information about your specific circumstances, your health, your longevity, your total assets, your spending goals, your gifting goals, your increased spending during your go-go years, and less later on in retirement. We're building a financial plan and taking all of this into consideration and helping you make decisions that will minimize the amount of taxes you pay not only today, but also in the future. So another vehicle analogy for you, typically your CPA is looking in the review mirror, helping to see where you have been, while a certified financial planner is looking forward, making a plan for where you are going. Okay, so let's discuss a handful of tax strategies we may consider as we go through your fundamental retirement plan. To start, a few of the most common impactful strategies we help new clients correct. Number 1, TFSA optimization. I dedicated an entire podcast episode just to this topic titled The $3 Million TFSA Strategy, episode 54. I lead with this because many retirees that come to us underutilize this account. At its core, if we can determine a withdrawal strategy that determines the TFSA accounts are likely never to be accessed for retirement income needs, the tax benefits to you, your family, and estate could be drastically improved by optimizing the TFSA. Next is non-registered account efficiency. We often come across non-registered portfolios in the $1 million plus range that are pushing out high amounts of taxable income. From a tax lens, we want to consider other options that mitigate these kinds of taxable distributions. For a retiree, significant taxable distributions from non-registered accounts can cause OAS clawbacks, can bump other account withdrawals into higher marginal tax rates, and limit the amount of RRSP deregistration that we can achieve. Which leads me to number 3, RRSP or RIF deregistration. This strategy spreads its tentacles into a number of other decisions that we have to make, like when to start CPP and OAS, and other spousal income splitting strategies to name a few. Ultimately, the goal here is to optimize your tax brackets and ensure your estate isn't hit with a massive 50% tax bomb at last death. In the final step of our process, estate planning, you will discover how the decisions we are making regarding your RRSP accounts may have a significant impact on your overall estate's final tax bill. Number 4 is pension income splitting and CPP sharing. These are two very distinct strategies, but I've combined them here for simplicity. At its core, the purpose of these strategies is to minimize household tax and increase after-tax household income. There are a number of nuances here that will impact pension income splitting, including your age, the type of account or pension, and in the case of CPP sharing, how long you've been married. Number 5 is controlling the timing of non-registered account or asset sales like rental properties. It's important that we consider how your retirement income and tax brackets will be impacted by triggering a taxable event like a rental property sale. As a nice, easy example, say you have a rental property you're looking to sell as you start your retirement. Assuming you have a substantial capital gain on the horizon, we may prepare your accounts and income for this taxable event. So, for example, maybe we delay drawing on RRSP accounts as we don't want to bump you into a higher tax bracket. Perhaps we want to push OAS back another year because we don't want you to be hit with a clawback. Or maybe we actually do a spousal RRSP contribution to offset this one-off high tax year. As you can see, tax planning is forward-looking, and we're constantly searching for ways to keep CRA out of your pocket. Now, if you're an incorporated professional or business owner on the brink of retirement, the plot thickens even more for you. In your case, maybe we want to consider reasonable income splitting opportunities with a spouse within the tax on split income rules. Maybe there are some ways we can optimize investing within your corporation while being mindful of foreign dividends in a corporation and passive income rules, which could see an erosion of the small business tax rate. We also want to monitor notional accounts within your corporation like the refundable dividend tax on hand when we structure the investments in your account. And we are also checking in on the capital dividend account to ensure it's being properly utilized and not being eroded by inflation. Now, I could spend another 10 minutes rattling off potential tax strategies that may apply to your situation, but I think you get the point here. We can look at literally thousands of scenarios. By using a more strategic approach and targeting specific tax brackets and areas of the tax code, we often find that we can utilize options available and can literally save you hundreds of thousands of dollars in tax, depending on the size and composition of your overall portfolio and net worth. That is essentially found money that we can use to address many other retirement questions and issues in the near term and later down the road. It also represents flexibility to spend, because when we thoughtfully deregister taxable accounts over time, you gain increased flexibility to make large purchases without the burden of getting pushed into a higher marginal tax rate later in retirement. At the end of the day, not managing and mitigating tax is a risk, just like any other. And one day you will have to pay your taxes. The question is, when will you pay those taxes and how much will you pay? We approach tax planning from the standpoint of looking at everything and then presenting you with options so you can make decisions with confidence. And ultimately, retaining the most income possible while paying the least amount of taxes. Okay, so that will do it for today's episode. Here are your action items for today. First off, are you currently getting tax planning advice or just investment advice? There are a few processes we have set up as a team that I am particularly proud of. We call these our tax planning value adds. Specifically, our fall tax letter, a document we send out to clients every fall, pinpointing the tax strategies relevant to them in the current and upcoming tax years. And second is our tax document package for your accountant to help make things easier come tax time. These client value adds are just a few of the ways we go the extra mile to provide you with massive value. Second, with the year winding down, we are starting to meet with our retirees to not only review their retirement portfolio, but also explore their tax planning opportunities for this tax year. I suggest you do the same. Okay, so that will do it for today's episode. Make sure you add us on all of our socials, LinkedIn and Facebook. If you've been enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure that you're signed up for our weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.